Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate mumbo jumbo. Today we're diving into the first quarter report of Amerant Bancorp, that's AMTB, for 2025. Get ready because this report is like a financial roller coaster, but hopefully less scary. Think of this as a bank trying to balance deposits, loans, and investments while keeping an eye on economic weather. Did they ace the test, or are there some storm clouds brewing? Let's find out. By the way, if you enjoy cutting through the corporate fog, make sure you're subscribed. There's also a Discord community in the description where you can chat with other finance nerds. This report covers Amerant's performance for January, February, and March of 2025. So let's jump in and see how they did. First off, a little housekeeping. As of April 30, 2025, they had about 41.8 million shares of their Class A common stock outstanding. This is just a snapshot of who owns what at that moment. Nothing too juicy here, but good to know. Now on to the index of the important topics in the filing. This is where management explains their numbers and any strategies they have in mind. Let's get into the real meat, the financials. Let's peek at the consolidated balance sheets first to understand what they own and owe. One key number to watch, their interest earning deposits with other banks jumped to around $588 million in March, up from roughly $520 million at the end of last year. This is good. It means they are being more savvy about where they keep their money, making it work for them rather than being static. We can see they had a good amount of cash. Then look at their debt securities available for sale. That sits around $1.7 billion as of March, up from roughly $1.4 billion. This shows they are investing more to make more. That's very Warren Buffett of them out and out. Let's see how the liability side looks. Their total deposits increased as well, about $300 million increase to over $8 billion. This is great news for a bank as they are always thirsty for deposits. This means their total liabilities are now $9.2 billion, an increase from roughly $9 billion, meaning their debts increased more than their assets. More is not always merrier. Now let's check their operations. Now let's scroll down to take a look at the consolidated statements of operations and comprehensive income. This tells us how much money the bank actually made. Interest income from loans came in at $121 million, roughly the same as the period last year. The same cannot be said for interest expense as it decreased, which we will talk about in a second. Their net interest income, that is, the money they made on loans and investments after paying their own interest costs, was about $86 million. So in 3 months, they made about $86 million. The interest expense in demand deposits decreased a lot from $17.7 million to just $10.4 million. This means that the bank did not have to pay as much interest on the same amount of money in demand deposits, which is a nice improvement. It's good to see they are cutting interest expense, however, it may cause depositors to flee if they are the lowest. Let's see how they allocated their money to account for loan losses. However, keep an eye on that provision for credit losses, which jumped from $14 to $18.4 million. That is roughly a 50% increase. Remember, those increased nearly 50% as well, which is not good. Non-interest income increased, meaning income from everything other than loans, such as fees, card servicing, etc. It came in at almost $20 million, which is also a good sign. So it was a great quarter operationally all in all. Now let's see where they lost this money in operations. Non-interest expense also increased by roughly $5 million, mainly due to professional fees. In terms of the salaries and employee benefits expense, it remained largely unchanged. The basic earnings per share, or EPS, a key measure of profitability, was $0.28, down from $0.32. This is not a very good sign as that metric decreased even though net income increased. More shares diluted the value. Other comprehensive income had a great change from being a loss to a gain. These are unrealized gains that go on their balance sheet. It is difficult to fully appreciate all of this without context. So let's bring that in now. The company operates as a single unit, meaning it's easier to assess overall performance. Makes my job as the decoder much easier. The big boss, the CEO, reviews net income as their main measure, so it makes sense to focus on that. Here is a great piece of news on April 1, 2025. Shortly after this quarter close, they paid off about $60 million in debt. Less debt now reduces future risk. They are also buying back their own stock. In the first quarter, they bought back about $5 million worth of shares. Companies tend to do this when they think their shares are undervalued, but this one might signal that there's no better use for the cash. The board declared a cash dividend. Basically, they are paying their investors. Here's some legal mumbo jumbo. As with all reports, the preparation involves a bunch of estimates. These are just that educated guesses and actual results can vary. Now, let's talk about where they keep their cash. The bank held about $588 million in interest-earning deposits. It's good that this number is earning more. This shows they are working to maximize their interest. Okay, so they are holding a lot of mortgage-backed securities, or MBS, which is common for banks for about $1.7 billion. They are mainly government-backed or agency and sponsored, which lowers their risk. These mortgage-backed securities have a range of unrealized gains and losses. Looking at those with losses, most of them have been underwater for less than a year. It may be due to interest rate movements. Also, municipal bonds are showing a little bit of losses. This is not good, but there's not a big amount to worry about here. So is it a big deal? No, not really at this stage. Check where these investments mature. It looks like most of them, well over $1 billion, won't mature for over 10 years. So these are long-term plays. The investment in equity is quite small and will not be worried about here. The biggest chunk of it is in commercial real estate, and the second biggest chunk is single-family residential. That tells us what they are comfortable lending against. So for now, to see how good the loans really are. Loans past due are still relatively low, so it doesn't raise any alarms. let's quickly skip though all of their loans. Their allowance for credit losses, which is their estimate of bad loans, is up to almost $100 million. That's not a great sign. As we discussed before that it increased, it seems we looked at all significant aspects of the filing is T. Well, that about covers it, and for the rest of the items in the filling. It's either not material to the general health of the company, not containing numerical values or legal definitions that will not be helpful for a general public to understand. These are some key things that I noticed copy as their cash position improved, their deposits increased, APUAN maintained, net interest income, but we are starting to see concerns about bad debts. As provisions for losses increased, their key ratios, ORO and RO, look normal, and earnings per share decrease slightly Rs. Most items for asset quality are trending in the wrong direction. The company appears to be in a solid and conservative financial position. So what's my take? Amerant seems to be a bank in transition. This has to be said in this filing. They are trying to do the best with what they have, but they will face many issues as it shows in the metrics. There is some concern about their CREAT concentration in NY. They are facing economic slowdown and may face challenges to revenue and earnings. This could mean the stock will have volatility in near term before it stabilizes. It also would have been nice to see them allocate cash to equity, but they decided to reduce long-term debt and repurchase stocks. So while the macro trends are against them, they are mitigating the effect. It's a mixed situation. Ultimately, would I invest? Well, they have a decent PT, so potentially, but only if the price is right. Alright, that's our breakdown of Amerant's first quarter. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Also, check out the Discord in the description to discuss it with other smart people. Thanks for watching. See you next time.